sign is an opportunity or that risks should be ignored. Rather, it highlights the importance of distinguishing between temporary market sentiment and long-term economic value. Another lesson involves liquidity. During the Great Depression, access to cash became critically important. Individuals who had reserves often possessed greater flexibility than those operating with no margin for error. This principle applies today regardless of income level. Financial resilience is not simply about maximizing returns. It is also about maintaining the ability to navigate uncertainty. Many people imagine wealth as a number, but history suggests wealth is better understood as a combination of assets, adaptability, time horizons, and behavioral stability. Someone with substantial assets but poor decision-making can experience severe financial setbacks. Conversely, someone with modest assets and strong financial habits may steadily improve their position over decades. The mathematics of long-term investing reinforces this idea. Wealth accumulation rarely appears dramatic in the beginning. Compounding often feels invisible until enough time has passed for growth to become noticeable. This creates a psychological challenge because humans are naturally drawn toward immediate feedback. We prefer visible progress, yet many important financial outcomes emerge slowly. The Great Depression also illustrates the danger of confusing economic cycles with permanent conditions. Every generation experiences periods that feel unprecedented while they are happening. Economic contractions, market corrections, inflationary episodes, technological disruptions, and policy changes can create enormous uncertainty. Yet history shows that economies continuously evolve rather than remain frozen. This perspective does not eliminate risk. Instead, it encourages a broader view of time. Investors who focus exclusively on short-term fluctuations often experience more emotional volatility than those who understand longer historical patterns. Context can reduce panic because it places current events within a larger framework. Another overlooked lesson concerns diversification. Concentrated exposure to a single asset, employer, industry, or economic assumption can create vulnerabilities that remain hidden during good times. Diversification is often criticized because it can appear less exciting than concentrated bets, yet its purpose is not excitement. Its purpose is resilience. The Depression reminds us that uncertainty is not an exception within financial systems. Uncertainty is a permanent feature of them. No forecast is perfect. No model captures every variable. No investor possesses complete information. Successful long-term decision-making often depends less on predicting specific outcomes and more on building systems that can withstand multiple possibilities. There is also a profound identity lesson embedded within economic history. Many people unconsciously connect their self-worth to financial outcomes. During periods of prosperity, this connection may feel harmless. During downturns, it can become psychologically damaging. Market values fluctuate. Economic conditions change. Personal worth should not be measured solely by temporary financial metrics. The investors who often navigate uncertainty most effectively are not necessarily those with the highest intelligence or the most sophisticated predictions. They are frequently the individuals who maintain emotional discipline when circumstances become uncomfortable. They recognize that fear and optimism are both powerful forces capable of distorting perception. Looking back at the Great Depression from a modern perspective, it is tempting to focus on what people should have done differently. Yet the more useful exercise is recognizing how similar human psychology remains today. Technology has changed. Markets have evolved. Information travels faster than ever before. Human behavior, however, continues to follow familiar patterns. When confidence rises, people often assume stability will continue indefinitely. When confidence falls, they often assume difficulties will never end. History suggests neither assumption is reliable. Economic systems move through cycles. Investor sentiment changes. Opportunities and risks coexist. Perhaps the most valuable lesson is that wealth is not merely a destination measured by account balances. Wealth is also the capacity to remain rational when uncertainty increases, to think beyond immediate emotions, and to make decisions that align with long-term objectives rather than short-term impulses. The Great Depression remains one of history's most powerful reminders that financial outcomes are shaped not only by economic conditions, but also by human behavior. Understanding that relationship may not eliminate uncertainty, but it can help investors approach the future with greater perspective, greater discipline, and a deeper appreciation for the psychological foundations of wealth.